Business objective number 4 is to meet shareholder expectations, and it is the last of our financial objectives here. What does that mean? Well, what are the shareholders? The ownership of a business is broken up into parts, and these parts are called shares. The person or group who owns the shares is called a shareholder. So if we took a sole trader business, there's one shareholder who owns 100%. In a partnership, maybe there's 3 shareholders. One person owns this bit, one person owns this bit, one person owns this bit. Remember, with partnerships, it does not have to be equal, and it doesn't have to be 2 people. It can be 3 or anywhere up to 20. And with a company, it's usually broken up into lots of little bits. It has many shareholders, and each person owns a different block of what we call shares. So that's what a shareholder is. A shareholder is an owner. But what do they want and expect? So this objective is about shareholder expectations. Well, fundamentally, we'll say they want 2 things. Dividends. What is that? They want the business to make a profit, which is then returned to the owners as dividends. And secondly, they want a capital gain. What does that mean? They expect for the value of the business to rise over time, so their shares in the business can be sold for more money than they were purchased for. Let's take a look at those each in turn. The first one, shareholders expect dividends. What does that mean? Well, the net profits of the business, 2 things happen. Either they are given back to the owners as dividends, or they're reinvested back into the business. And why do we do that? We do that to hire better people, buy better equipment, make better products, do better marketing, etc. What do shareholders want? Well, shareholders want this one, don't they? They want the dividends or the profits to go to them as dividends. They don't mind this one. If it goes back to making the business better, that's good too. But fundamentally, shareholders expect this one. They want dividends to be returned to them. So owners in a business receive a dividend based on their percentage ownership in it. So let's take a net profit of 100,000 with a sole trader. So the profit was 100,000 and all the profits are going to go to the owner. Well, in this case, there's one share in the business owned by one person. That shareholder would get $100,000 of the profit. What about with a partnership? So let's take a partnership with 3 shareholders. There's 10 shares in this business owned by 3 people. This person owns 3. Or 30%, this person owns 2, or 20%, and this person owns 5 of the shares, or 50%. The profit's 100,000. Well, we split it up based on percentage ownership. So this person's going to get 30% of that, which is 30. This person's going to get 20% of that, which is 20,000, and this person's going to get 50%, which is 50,000. So your profit is based on your percentage of ownership. And with a big company, they have hundreds of shareholders, if not hundreds of thousands of shareholders. So let's just take a company with 100 shares. There they are. Each person owns a different block. This person owns these 4 here. This person owns 2 there. This person owns the 4 pink ones, etc. The profit's 100,000. So we split that $1,000 for each share here. So each person gets, take this person had 4 shares. They will get $4,000 of that profit. This person here had 22 shares. They'll get $22,000 of that profit, etc. What about that second expectation, capital gain? Well, think about when people buy a house. That's probably the easiest thing to relate it to. They hope the value will increase over time so they can sell it for more than they bought it for. So just take this house here. In 2011, bought for $700,000. Maybe today it's sold for $950,000. That difference, or that's actually a profit. But when it's on an investment, we call that a capital gain. And that's what an owner wants in a business. They want to make a capital gain. They want the business to be worth more than they bought it for. It just works a little bit differently depending on what sort of business you have. So if you're a sole trader, you're selling the entire business, 100% of it. If you're a partner, you're just selling the bit that you own. And likewise with a company, you're just selling the bits that you own, not the whole business. Okay? With a sole trader though, you're selling 100% of the business. So how does that work? Well, let's take a sole trader. Let's say this sole trader bought the business for $60,000, all of it, and then they sold all of it for $100,000. They've made a capital gain of $40,000. But partners can just sell their slice. So let's say this partner here bought 20% of the business for $120,000. A few years go by and they just sell their little slice of it for $200,000. Well, that's still a capital gain, just of $80,000. And shareholders in a company, you're buying usually per share, particularly if a company's on the stock exchange. So $8 per share, they bought 4 shares at $8. That's a total of $32. And then years go by and they sell it for $11 per share. So that's 4 times 11 is 44. But usually we express it per share. We would say there's a capital gain there of $3 for every share that they had in the business.